Tuesday Coffee with Dr. Anna. Can AI, earnings, and gold keep the market rally alive? Hello, everyone, and welcome to another edition of Tuesday Coffee with Dr. Anna. Whether you're watching from London, New York, Singapore, watching from New York and the United States, Singapore, and our friends across Asia, Nairobi or Montenegro, thank you for joining me for this week's update. Every week we cut through the market noise and focus on what really matters for investors. Today we're discussing one of the biggest questions facing global markets. Can second quarter earnings keep the US stock market rally alive? This isn't just another earnings season. It could determine where markets head for the rest of 2026. According to Goldman Sachs research, corporate earnings, not higher valuations, generated virtually all of the S&P 500's gains over the past 12 months. That means companies now need to prove that the optimism around AI and economic growth is translating into real profits. The earnings season begins during the week of the 13th of July, and expectations are extremely high. Analysts expect S&P 500 earnings to grow around 22% year over year, while Goldman Sachs forecasts approximately 24% earnings growth for the whole of 2026. Those are ambitious numbers. The market has already priced in a lot of optimism. If companies beat expectations again, we could see another leg higher in equities. But if earnings disappoint, volatility could return very quickly. The biggest spotlight will be on the world's largest technology companies. Over the last 2 years, we've seen hundreds of billions of dollars invested into artificial intelligence. The question investors are now asking is simple. Where is the return on that investment? During the first quarter, we started seeing encouraging signs. Revenue improved, margins expanded, large customer backlogs continued to grow. Companies demonstrated that AI isn't simply a research project anymore. It's beginning to generate commercial value. However, investors are also becoming more selective. Many hyperscale technology companies continue spending enormous amounts on AI infrastructure. Free cash flow has weakened, debt issuance has increased dramatically, and markets are questioning whether every company will become an AI winner. That explains why we've recently seen money rotate away from some of the largest technology companies into businesses supplying the AI ecosystem, semiconductors, networking equipment, electricity infrastructure, and data centers. AI is creating an entirely new capital cycle. I actually think we're witnessing something much bigger than another technology boom. Artificial intelligence is becoming an infrastructure revolution. Goldman Sachs estimates the global AI buildout could require around $7 trillion between 2026 and 2031. Think about that number, $7 trillion. This isn't only about NVIDIA or Microsoft. It's about power grids, energy generation, semiconductors, robotics, manufacturing, defense, construction, real estate, private credit, infrastructure funds. Even sovereign wealth funds are increasingly becoming direct investors in AI infrastructure. In other words, AI isn't replacing the economy, it's rebuilding it. Why the halo trade matters? One of the most interesting themes emerging this year is what's called the halo effect. Halo stands for heavy assets, low obsolescence. These are companies that own essential physical infrastructure, utilities, electricity networks, industrial manufacturers, defensive industries, engineering companies,
transportation infrastructure, data centers.
These businesses may not sound as exciting as AI software, but they're becoming incredibly valuable because AI cannot function without enormous amounts of physical infrastructure. Goldman Sachs believes these capital-intensive businesses could continue outperforming because governments and corporations are investing heavily in energy security, reindustrialization, and AI infrastructure. What about gold? It's a question I'm asked often in times like these. While everyone is watching AI, don't ignore gold. Gold experienced a pullback during the first half of the year. But Goldman Sachs expects prices to recover during the second half of 2026, potentially reaching $4,900 per ounce by year end. Why? Because central banks, particularly in emerging markets, continue diversifying their reserves. If interest rate expectations eventually shift from hikes toward future cuts, investor demand for gold could strengthen once again. Gold remains an important portfolio diversifier during periods of uncertainty. My view, as someone who has spent over 20 years managing institutional portfolios, I always remind investors, markets don't move because of headlines. Markets move because expectations change. Over the next few weeks, investors will be watching several questions very closely. Are companies delivering earnings growth? Is AI generating real returns? Which sectors are actually benefiting from the AI revolution? Will infrastructure continue outperforming software? And are today's valuations justified? Those answers may shape investment performance for the remainder of this year.
Thank you so much for joining me for another Tuesday Coffee with Dr. Anna.
If you enjoyed today's discussion, please like this video, subscribe to the channel, and turn on notifications so you never miss our weekly market insights. And if you'd like to start learning investing with AI completely free, I'd love you to try AIMi, our AI-powered financial intelligence platform. Start today at chatami.ai/chat. Whether you're just beginning your investing journey or you're an experienced investor looking for deeper market intelligence, AIMi is here to help you make more informed financial decisions. Thank you for watching. Have a wonderful week, and I'll see you next Tuesday for another coffee and another conversation about the future of finance. Take care, and I'll see you next Tuesday.